There's a lot of people who don't really understand the impact that liquid staking or MEV or the combination of these things together is going to have.
Welcome back to another episode of 0x Research, the show hosted by analysts for analysts, where we dive deep into the crypto ecosystem. This show is made possible thanks to our incredible sponsors, Chainalysis and Flipside. Today we have a great interview with two authors from the Atom 2.0 Whitepaper, Sam Hart and Youssef Amrani. Given that the 2.0 proposal didn't pass and failed with a no with veto in governance, there's a huge discussion around where the Cosmos Hub is today, what the vision is for the future, and how the protocol proceeds from here. So we have a great discussion with that. But before we get into it, we're joined by 0x Pibbles and Westy from the BWR research team here to discuss all the market happenings. My friends, how are you?
Doing well, man. How are you doing?
Doing well. It's been a ton of craziness to talk about, right? With the unwind of the FTX and the subsequent contagion that spilled out of that. I feel like we could have a whole podcast episode doubling down on all the information we've seen since just last week. But we do have a pretty long interview today with the Atom 2.0 guys, so I want to kind of jump right into hot seat, cool throne, and I feel like we're going to hit a lot of the hot news in the past week during this session anyways. So Sam, you want to start us off?
Yeah, for sure. For the hot seat, I've got Bill Ackman. He's a prominent TradFi investor, and he was tweeting about HNT, which is Helium's token, and touting a partnership with Limebike, but it wound up being a fake partnership, so obviously he wasn't super well informed. And then Helium's moving to Solana, and obviously we've talked about Solana a lot in the past couple episodes, and they're struggling a lot. And he also deleted a quote tweet praising SBF for taking responsibility on the whole situation. So that was absolutely brutal. It's rough to see these big names just kind of acting like they know what they talk about when they really don't know what they're talking about. So Bill Ackman got the win there for me.
Yeah, Helium's like the perfect protocol that sounds nice on paper, and so when someone brings that up as a great example of crypto that they have no idea what you're talking about, because when you dive in deeper, I think the revenue numbers for last year were like $6,000, like something ridiculously low, and so it sounds good on paper, like having 5G like anywhere you want in the world, and anyone can set up their own device. Like it seems awesome in theory, but then when you actually look at the money involved, it's not very good at all.
I actually have the Helium V2, which is Hive Mapper. It's the dash cams. I ordered one of those, so I'm going to be putting it in my car and driving around from back Helium.
What's the lead time on those? I'm curious if you've received it yet.
Nah, I want to say I ordered that thing February or March. Haven't heard anything. So I don't know. It'll be here by 2025.
Okay, that's about what I expected.
Westy, who you got in the hot seat this week?
Yeah, this week I got, I guess, Shark Tank crypto players. And so the first guy I have to call out is Kevin O'Leary, who was pretty big into crypto and a big investor into FTX. And then this past week, after the entire FTX collapse, he's actually been helping Sam Bankman-Fried raise money for FTX right now, and was asked if he were to do another venture, would you help fund him then? And he said yes as well, which is absolutely wild given all that FTX has done, given that all the equity that he put into it went to zero. It just spells disillusionment, and it's just not good to see that anyone's helping SBF at this point. And then Mark Cuban this week, there was a bot on Twitter that picks up the people that he follows and unfollows, and it found him basically spam unfollowing any crypto account he followed before, like Uniswap, any other protocol, etc. And so we're seeing capitulation from him, despite him being a pretty big bull in the bull run. I know he was on Bankless for an episode, really an ETH bull as well. And so, yeah, seeing capitulation from one of the most outspoken investors in the world is, I guess, a good sign for bottoming, but we'll see.
Yeah, that's pretty cringe. You hate to see someone chasing their bags to zero, and that sounds like exactly what Kevin O'Leary's doing. How about you, Pibbles? Who you got?
Yeah, my hot seat is UXD protocol. They were a delta neutral stablecoin on Solana that saw zero adoption. Prominent investors included Alameda, Multicoin, CMS, They actually had a token unlock on November 14th, and the price plummeted from like 1.8 cents to 0.007, basically overnight. And what's funny is they raised like a fair launch. It was $16 per token after launch. So they just like cash grabbed a ton of money from people building out the future of DeFi on Solana. Turns out seed investors got it for 0.003. So they're still a little over 2 times right now. But the sweetest part of it is, so it was 460 million tokens were circulating before the cliff unlocked. And then they just injected 1.1 billion more tokens. So it just freaking, like, the market cap is more now than before the unlock, even though the price tanked. And the best part about it all is basically the biggest MEV trade on Solana happened on November 17th. And we don't know who it was, but it was clearly one of the seed investors. And they tried to dump like $700,000 worth of tokens and got slipped to hell, like 98% slippage or something, and it got eaten up. So they actually took a major L there, which is, I don't know, it's kind of sweet karma. I hope it was, I can't say who I hope it was, but you know, that's, you love to see that. You have these venture investors who think they know everything about crypto, and they put on this huge front, and they don't know how an AMM works. And then they go in there, try to dump their tokens, which they're supposed to be good at, and they just got wrecked. So UXD, bad project.
Yeah, since the start of this podcast, we've had the hot seat has been very unkind to Solana, its figureheads in and around the protocol, as well as the protocols themselves built on top of it. So if the day ever comes where we see Solana in the cool seat, it'll be a very interesting change of pace, and it'll feel like we've come a long way since the start of this podcast, that's for sure.
Dan, who you got in the hot seat this week?
The hot seat for me spills out of this FTX drama and the ensuing contagion. So GBTC arbors are in the hot seat for me. This was like the touted solid trade of buying GBTC shares and shorting Bitcoin just to capture that arb. It was trading at like a mid to low double-digit discount when this kind of started becoming like a really popular trade and highly talked about on CT. Today, the discount is down to 45%. So massive swing there, and it's a little bit painful to see that trade still coming alive, especially because so we saw Genesis in the news last week, the end of last week. They paused their earn program, they paused withdrawals, and there seems to be a balance sheet issue there. So the parent company, Digital Currency Group $DCG, was rumored to be on like a pushing a raise to try to get some capital for them. And there's also been about $1 billion of authorized repurchases from GBTC's. So the company that started GBTC is Grayscale, and Grayscale's parent company is also DCG. And so if they have if they've executed all of their authorized purchases, they'd own roughly about $1 billion of GBTC. And so Nick Carter actually had a great pitch on this of, well, here's an easy way to solve the DCG's balance sheet problem is, say Grayscale said, all right, in 2 months time, about 2 years time, let's say GBTC was eligible, you could take one share of GBTC and redeem at NAV, or maybe take cash on delivery at the same net asset value, and that would actually, since DCG owns such a large portion, around $1 billion of GBTC, it would make a ton of sense for them to say, hey, if this, let's help close this ARB, and then, maybe that would give us the potential to solve this hole in our balance sheet, while also, benefiting the broader market. So yeah, it's been a terrible trade for a while, but it seems like we're going to get a resolution here. How that gets resolved will be interesting, but it's a bad day for the GBTC arbors that started back at a 10% discount to see that get blown down to 45.
Yeah, that's a funny proposal from Nick Carter too. It kind of reminds me of ST-ETH, how it's going to be redeemable in probably a year to 2 years for the underlying ETH that's staked. So kind of funny to see Nick Carter being a proponent of a current mechanism in DeFi already. But in terms of Cool Throne, we can get over to that section now. I've got Lens protocol. They are seeing highs in daily active users. There's no token incentives yet, so it seems to be somewhat organic. I mean, I'm sure there's some people who are trying to game a potential future airdrop, but for those who aren't aware, Lens is basically the back end of decentralized social media, and anyone can kind of build a front end for it. So it's going to be really cool to keep watching that and see if we can actually transition to like a decentralized social media that everyone can kind of own a piece of and not be monetizing their own data to the likes of Meta or Twitter. So they're definitely on my Cool Throne this week. Any thoughts?
Yeah, I think that makes a lot of sense, especially when you saw like all the teams stepping down at Twitter, and then the rumor that like Twitter was just about to like quit working. It's like, well, we got Lens.
I think there's huge irony around like, we saw, this is the end of Twitter, but in reality, like Elon's been tweeting about how Twitter's been doing record numbers recently, and it's like, is the threat that firing 90% of your staff will break Twitter, or is the threat to everybody else who sees Twitter working with 90% smaller of a workforce? So that's I definitely don't own that quote. I saw it somewhere on Twitter, but totally blanking who it was. But it was a great perspective, right? That just totally shifts like what we think we know about modern tech companies.
I also think it's a very low probability that Twitter shuts down, although there were a bunch of rumblings about that. But even so, like, think about all the conversation on Alpha that gets shared on CT. Like, if that were to migrate to some decentralized social media with a token involved, like, you could imagine that gets a lot of value if something like that were to go down.
Yeah, 100% agree. That's kind of my thought process for putting them on the Cool Throne this week. And it's also not a very easy week to try and pick out a Cool Throne recipient here. So, Westy, I'll pass it over to you to give your take.
Yeah, definitely agree with that. My Cool Throne this week is Flashbots. So essentially we've explored before how they have a really big sort of monopoly over the builders market in MEV Boost. And as a result, they open sourced their relay at first, but they found out that they still have the centralizing force. So they just recently open sourced their builder as well. And so that should help alleviate a lot of the concerns around censorship, since Flashbot's relay has a majority of the blocks go through them, and their block builder specifically builds blocks that are OFAC compliant. And so now that they open source their code for their block builder, which is often building the highest value blocks, now we're going to see more people be able to get into that field. And I can imagine they open source their searchers as well, and so we're going to see a lot more diversification when it comes to MEV Boost building in the MEV markets.
So what does that mean for Manifold? Is Manifold just dead now that they open sourced everything?
Kind of. I don't know if that has to do with open sourcing, but I know SushiSwap is exploring other partnerships besides Manifold. Their token's down 90% in the past 2 months, and the founder's kind of MIA at the moment, along with the fact that their relay was lying about like block rewards that were going through their relay, and so I think there's just super low sentiment on Manifold at the moment. But in terms of block building, I mean, not a lot of blocks go through their relay anyway at this point, and so yeah, I wouldn't call them dead, but it's not looking good for Manifold.
Yeah, I can go ahead and close this out then. I got Index Coop in the Cool Throne. They actually are working. They actually posted a governance form a couple months ago, back in September, to launch the Diversified Staked ETH Index. Which, quick background on Index Coop is basically they create on-chain strategies where users can hold one token that reflects like a basket of goods on the back end. And so there's Diversified Staked ETH, or DSETH as they're calling it, will basically hold a basket of staked ETH derivatives and then allow the user to just hold DSETH and take like the combined risk profile of the backing for like the staked ETH backing, right? So you could hold like Lido staked ETH, Rocket Pool ETH, or like a Stakewise ETH or a Frax ETH as well. And then instead of that would allow the user to not have to pick like, okay, maybe I'll use this back-end technology, like whether that be Lido, Rocket Pool, or any of the others. The user just gets to hold one asset that is accruing the rewards of the combined basket, which I thought it's a really cool idea to kind of like diversify away some of that smart contract risk. I mean, I guess depending on how you look at it, maybe you're introducing, but the optionality of crypto is really one of its core components, and it's great to see people innovating on like these basket good products.
Does that work like RETH where it automatically rebases?
Yeah, so it'd be interesting to see how that goes. But in the original proposal, right, they did mention staked ETH and RETH within the same basket. So I think that would definitely need some tech build out on the back end, right? Just because of how those two the assets themselves are constructed. Like maybe you'd only have to hold baskets of rebasing tokens together. Yeah, I don't know. That'll be interesting to see how that goes. But this gives like a nod to the Frax model, right, where they broke apart the rebasing token and then like the stablecoin pegged token, right? So they have like SFrax ETH, which actually accrues the rewards, where just regular FRX ETH is basically like a wrapped ETH. So yeah, it gives a little nod to that model at being like a little more tangible and can work in different protocols, but I'm not sure exactly how that's going to work on the back end.
Yeah, also reducing the slashing risk is probably a good thing, and then anytime you can make something more accessible to a wider group of people is always a positive. But Dan, I might have to throw you on my hot seat next week because you forgot Pibbles. We got to get Pibbles' take here.
Yeah, so let me come in with the cool throne. I have Titanium Dollar, T1.money. Anyone who got in that early is just absolutely printing right now. TVL is about to hit 20 mil. APY, single side staking, is at 18,000% annualized. And then if you bond that, it's at 63,000% annualized. By the time this podcast airs, it will have probably collapsed. But if you got in like pretty early, I mean, you're printing, it looks like 1% every 30 minutes. Each epoch is 30 minutes. So you have the greatest algo stable fork of all time, and you could just be sitting there on your ass making generational wealth.
I apologize for forgetting about you there, Pibbs, but I'm really happy you brought this up because I found this on Friday and brought it up to Westy and Matt, and I let them talk me out of this by providing rational facts about why this is a terrible idea. Little did I let myself realize, it's maybe Ponzi seasons are back. Yeah, of course they're not good ideas, but that doesn't mean we shouldn't be in them at early points in the cycle.
I mean, running the numbers, this is literally Olympus DAO on steroids. Like, the supply is expanding at a ridiculous rate. There's probably one person with a very large amount of the supply that's just farming this and just waiting and waiting and waiting, and will finally dump on everyone. And so eventually it'll collapse, but the question is sort of when. And obviously we timed it not very great, but I still think it'll definitely collapse pretty soon.
The curve pool is really healthy right now. It's like 40% titanium money, and then it's like 30% Tether, 10% DAI, 10% USDC. And they're sitting at I think 4.5 mil TVL in that curve pool. So right now it's pretty healthy, which means if we would have gotten in on Friday, we'd be sitting pretty and probably exiting right now.
I will say using a stable swap was definitely super smart because it'll keep the prices in line for a lot longer than something like an XYK. So I'll tip my hat to that.
If they really wanted to get carried away and thought they had some longevity in this Ponzi, they would have used the Frax base pool and thrown back some incentives and really kept that flywheel kicking.
Yeah, we're going to have to fork Titanium and do it all with Frax. We'll run it back. Pre-sale on the 0x Research podcast.
I just like it how you called it T1.money. It sounds like a rapper name or something like that. That's definitely something I can get behind. Dan, you want to pull up the Flipside chart of the week for us? Yeah, so right now I'm looking at some stats on GMX and Gains Network. And as Westy pointed out last week in the hot seat, these protocols have been absolutely dominating because of all the drama that's been happening with centralized exchanges and people wanting to custody their own funds. The charts show basically all-time high in the weekly number of trades, and then the weekly number of active users, the amount of volume. So it's really impressive what these protocols are achieving in lieu of all the FTX Alameda drama. And yeah, it's great to see that kind of adoption on the decentralized exchanges going forward. Flipside has some of the most comprehensive on-chain data in crypto to get you the insights you need to work smarter. You can instantly query the data yourself for completely free, or even just browse other people's dashboards to find some alpha and give you the edge that you need to win in trading. Check out Flipside's data for yourself and earn some USDC, and complete 0x Research's exclusive bounty to earn up to $75 of USDC. It'll be linked in the show notes, so be sure to check it out.
And then lastly, before we hop over to our interview with Sam Hart and Youssef Amrani, I just want to take a second to thank Chainalysis. They're one of the leading crypto analytics providers that help legitimize our industry, and they enable investors to track funds on-chain with ease. They have great tools designed exactly for this purpose. And they also offer some great research that's free on their website. So if you're looking for some market research, maybe DeFi research, I'd definitely check out Chainalysis. And we'll definitely put a link in the show notes to make that a little bit easier on your behalf. But without further ado, I'd like to get ready and strap in for this awesome interview with two of the Cosmos Hub core contributors.
All right, today we're joined by two co-authors of the Atom 2.0 white paper, Sam Hart and Youssef Amrani. Thanks for coming on, guys.
Thank you very much for having us.
Yeah, happy to be here.
Yeah, so I want to jump right into it. Obviously, the elephant in the room is last week's Prop 82 failing, which was basically signaling the support for the 2.0 white paper that you two co-authored. And it failed as a result of 1/3 of Atom voters voting no with veto. No with veto allows, like I said, 1/3 of voters to kill a proposal. Do you believe that's the intended use of the no with veto function?
Yeah, so I can speak to this. Let me just give a little bit of background on the no with veto architecture. So, or the voting architecture in general, so kind of understand what's happening with no with veto. So, the governance system, the gov module in the Cosmos SDK, which is common to all Cosmos chains, has there's basically a quorum system. So a server of a certain amount of the staked assets need to vote in order for a proposal to be valid. And then of the staked tokens, if 50% or more is voting in favor, then the proposal will pass, unless there is a veto in which 33% or more of the staked tokens, of the voting tokens, are voting no veto. There's a couple options in the voting module, or in the gov module: yes, no, abstain, and no with veto. So to now answer your question, well, actually, before I even answer that question, what is the kind of intended use of no with veto? Well, it's supposed to be a mechanism for protecting minority rights, effectively. So there's a couple ways to come at this. I've actually previously worked with a team, Haifa, who's also represented on the paper, to kind of go through a kind of detailed semantics of when to vote with no veto. And the idea is basically okay, there's a minority population within the chain that strongly dislikes something, and really feels that their interests are disproportionately being infringed upon. I mean, you can analogize this to voter disenfranchisement in U.S. electoral politics or something. Making sure that minorities are enfranchised is a really important part of a legitimate voting process. and it's hard to achieve in a decentralized setting. So this is trying to make sure that a minority population is able to have an outsized voice. There's some challenges with implementing a mechanism that is able to kind of enfranchise a minority population, and that is the creation of what's effectively a filibuster. So if a minority is able to block proposals or block progress without kind of sufficient disincentive, then you end up with what looks very much like a filibuster in like the U.S. Congress and Senate, and it's a an impediment to progress. There's some debate as to the the value of that. Now I can finally answer your question. Was this no with veto used correctly? And there was certainly quite a bit of confusion around how this was supposed to be used, and I spent a long time discussing with different validators, like their decision making around it, and there's definitely a lot of confusion. But I do genuinely think that a lot of people were using it correctly, and at the end of the day, it's a mechanism for people to express their interest or express their opinion. And a lot of people had some issues with the paper, and decided to make that known. So we're happy to talk about why.
Yeah, that segues me into the next question. I'm curious, why do you think it was rejected?
Well, I can maybe answer this one. So I think there are a few elements. The first one being that the scope was very large of the paper. We had a few core products that were not necessarily easy to understand. And so we got a lot of feedback from validators that it was just too big for one vote. The second element within the white paper, I would say, was concerning for a lot of people, a lot of atom holders and delegators and validators, was the new minting that we wanted to that was supposed to basically create and fund the treasury. So the issue was with the minting and the size of the minting. Atom holders were scared to lose control. They were scared that we didn't have enough guarantees on the future governance of the treasury, and there was also some concerns about the way we basically prepared that white paper. Some people said there was a lack of transparency, that we worked kind of in a closed room, and so that was, I think, a big point that hurt us. And lastly, I think also there was a cultural gap that was an issue because it reduced inclusiveness. Sorry. And some validators, notably some from, for example, France or North Korea, they felt they were left out because of the language barrier. So I think there were a few other elements. Maybe Sam wants to expand more on the other elements.
I mean, just want to correct South Korean validators, not North Korean validators.
Yeah, important distinction there. I appreciate that explanation. And Sam, you mentioned that you had talked to a couple of the different validators. Like, do you know who was voting no on this proposal? And like, was it similar to the situation back in May on Prop 69, where you were trying to get Kazem Wazam on the hub, and then Jay Kwan kind of forced his number in there, or is it a kind of a different setup this time around?
There's a lot of similarities. Notably, Jay was also against this proposal, and we can talk about the kind of Jay's influence and his relationship to some of the other core teams in a moment. But my assessment is that there was kind of two camps. Like, one is a set of constituents that were pretty kind of aligned with Jay, or like just kind of respect his opinion, even though it is kind of, yeah, and that opinion, you know, is kind of swung to being opposed to the proposal at the end of the day. And then the other is kind of the camp that Youssef is touching on, which is basically people who felt like it, you know, there's a lot of changes. It was happening fast. There was maybe, I mean, it was like hard to digest. Felt like there was some loss of control potentially, and you know, there's potentially a couple like minor changes that they'd like to see to make sure that it was really working in their best interest.
Yeah, I think that makes a ton of sense. So I guess this, you know, now we reflect on like the situation and where we are, right? So Atom 2.0, you know, was a signaling proposal to really push forward what the white paper had laid out, and kind of signal to the developers and the community, like, hey, this is the direction that we're going to be building in. So the ultimate question really boils down to, so you know, what's next? Where do we go from here? You know, there was 4 or 5 like really key elements within the proposal, right? So such as interchain security, liquid staking, the economic engine with the scheduler and the allocator, as well as like the revamped monetary policy for Atom. So, you know, is the process now to like take each of these into their own proposal and try to push them through one at a time? And then is that like the best way to hone down and say, hey, like, all right, so let's take interchain or maybe let's take liquid staking, for example. What are the risks here? And like, do we push this through one at a time? Yeah, I guess is the next step really to push these things through one at a time.
Yeah, I think the proposed path going forward is basically to, like you talked about, slice the Atom 2.0 vision into smaller pieces. And so I think one important thing to note is that interchain security is going live in January, so that's almost done. And liquid staking is already available on multiple protocols in Cosmos. So it's really about the 2 other pieces, which constitute the Atom growth engine, which are the allocator and the scheduler. So about the next steps, I think we just, like, in the immediate term, there is a discussion to increase the tax on staking rewards and to direct them to the community pool. So right now the tax is at 2%, and so there are discussions to increase that to possibly up to 15%. Probably it's going to be 10%, but we don't know yet. The proposal is not live yet, so it's just discussion on the forum, but that gives us an idea. So that would be, I think, the first step, and the second step in the immediate term as well is to enable interchain security, because we need to whitelist it with governance as a feature, and then as soon as we have ICS whitelisted on governance, there is a bunch of subsequent proposals to whitelist each individual consumer chain. So right now I think we have like 7 or 8 that are confirmed. So we will need an individual vote for each of those chains. And then in the immediate term, you know, once the community pool is properly founded, we can think about funding the allocator and the scheduler. So first whitelist them, like have, you know, a proper debate, provide enough documentation, financial projections on the allocator and scheduler, and then, you know, go on chain. So it's really mostly about pacing ourselves, pacing the Atom 2.0 vision, and, you know, in the meantime also ensure better alignment with larger validators prior to voting. And I think also one thing that is going to be critical that we can learn from what happened with Prop 82 is to reduce the cultural gap to foster more inclusiveness and governance. So we're going to need a few maybe translations of the different documentations and of the on-chain proposal. So I think that's what we're dealing with in the short to medium term.
This like growth engine piece, people, there was very little resistance to those ideas. Just to summarize, like the main idea there is like the allocator. There's two pieces: the allocator and the scheduler. The allocator is basically an instrument for forming collateralized partnerships with other chains or token projects, and that could take the form of like early investment. You could do something like a token swap where both of the tokens are locked up for a year in an LP together, so you're kind of mutually offering liquidity. It's just kind of a general purpose system for creating cooperative relationships between chains, and this is really like already a core idea to the Cosmos Hub. Like the Cosmos Hub and Atom is the primary, it's the primary vehicle for funding the public goods in the entire ecosystem. Like, and everybody wants that to continue. So the kind of core business of the hub like needs to be ecosystem aligned. So that's a hard requirement. So yeah, that allocator basically like helps new chains grow and provides capital, liquidity, partnership, and then the scheduler is a kind of shared block-based market, which we think is again ecosystem aligned. Basically, the business will grow as more chains are developing economic relationships with each other, and it's also like a pretty complex problem that we really think there needs to be kind of like a diversity of solutions for, and a kind of fully on-chain, trust minimized, secure solution seems like a good option for many chains to have kind of in their toolkit.
Yeah, absolutely. And I kind of want to take the, just as you mentioned, the next steps forward for the Cosmos Hub itself is to kind of like take each element of this proposal and slice it up and kind of work through them one at a time. So that's exactly the approach I'd love to take throughout the rest of this podcast. And so if we continue on with this growth engine, right, the scheduler and the allocator, loved the explanation you provided for both. And the original thought was to build these directly onto the hub. Does it still make sense to try to push forward that path or in that direction, or in order to like stick a little closer to the credible neutrality theme as some of the community still really appreciates? Does it make more sense to build the scheduler and the allocator out into like their own consumer chains and kind of bring them to market in that way?
The plan was always to have them as consumer chains. That was it's not like specified in the paper. Maybe we should have, but it was, the idea is like it shouldn't really matter for the core business proposition. Like it's a little bit of an implementation detail if it's like on a consumer chain or on the core. Obviously, it has significant security considerations that go into that decision, but it just makes more sense to build these on consumer chains at the end of the day. Like it's easier, you can iterate faster, it's more secure. Like, yeah, that was kind of the plan from day one.
Right, and then you mentioned that there was no real pushback from the community on the kind of like creating these things and implementing them into the Cosmos Hub, right? Because this is, the scheduler really helps align the growth of the broader ecosystem with the growth of the Cosmos Hub's revenue, and the allocator kind of does, works in the same direction, right? So this is kind of helping building out a more scalable way for the Cosmos Hub to actually kind of sit, at the helm in the interchain ecosystem. And so I'd love to dive a little deeper, if you don't mind, on the scheduler itself. I just find, that whole landscape of cross-chain MEV so fascinating, and for the listeners, just a quick reminder: MEV is the profit a privileged entity can extract or create by including, excluding, or reordering blocks, which makes the right to order these transactions in a specific block valuable. And so the interchain scheduler itself would create a marketplace for tokenized consumer chain block space. So any consumer chain that is taking its security from the Cosmos Hub, it would then have the ability to sell some of its block space in this marketplace. And so ultimately, the way I view this is this is like a way of creating revenue off of consumer chains, right? So because the scheduler can only, if I have this correct, the scheduler only works for consumer chains. If you're not a consumer chain, then it doesn't have the ability to sell the block space on this marketplace. And so I just want to make sure we have that piece right. And if so, then, so the interchain security really does sit at the center of this whole growth plan.
It's mostly correct. The only thing that we need to specify is that at first it was supposed to be consumer chains, so the MEV for all the ICS consumer chains. But later on, if we see that there is a strong product market fit, then we can expand that to any Cosmos chain that wants to opt in the system. So I can let Sam, because he's more experienced in the MEV space, answer the rest of the question.
Yeah, that's exactly right. I mean, at the end of the day, it would be kind of including a specific module into your chain, and making some adjustments to like the end block or something along those lines. So, conforming to like an interface that allows you to interact with the kind of central auction. So like you said, that there's very little pushback on both of these systems. The scheduler, there is like market risk involved in this thing. To be perfectly honest, I think there were a couple people who expressed some, confusion or, concern, largely just because there's just a lot of unknowns in the MEV market. Like, it's just really, really new. And this is a pretty like radical proposition. The kind of value proposition for these chains is like you can actually charge a premium on the block space, and so you can get more money for the space that's being offered than you would otherwise, just offering it in your kind of fragmented market on each chain.
If you can't tell, we love data here at Blockworks Research, and Chainalysis, the leading blockchain analytics company, shares this passion with us. We use data to extract alpha and find the next thing coming in DeFi, but Chainalysis is doing the gritty work and building trust in blockchains. To onboard the next $1 trillion of capital into the industry, we need to grow safe consumer access to cryptocurrency and promote more financial freedom with less risk.
Chainalysis has some of the most comprehensive and reliable data in the space, and they use this data to power a full suite of their solutions that can be utilized by industry professionals. Best-in-class training and certifications are also led by Chainalysis and some of the brightest minds in the space. If you haven't heard of Chainalysis, you got to check them out, and we'll link to them in the show notes.
Can you talk a bit about what the MEV marketplace looks like, or the interchain MEV marketplace looks like today? In the white paper, it discussed a lot about how a lot of that takes place off-chain today, and within that as well, I know there's some different risks that are the case when this marketplace is off-chain. So I'd love to hear you kind of like dive a little deeper on that.
Mm-hmm. Yeah. So if you actually look at MEV and Cosmos today, like the only player is Osmosis today. So like there's a lot of kind of projection going on. There's Osmosis pool to Osmosis pool, and then there's like Osmosis to to like centralized exchanges. Like those are that is where MEV is happening. But so and osmosis like does not have a lot of adoption. I believe there's no adoption of like third-party MEV relay services. So the two prominent ones in Cosmos are Skip and Mekatech. So all of the kind of MEV that's captured there is just the kind of priority mempool, like priority gas auction games. So yeah, you have to do think a couple steps ahead to like understand what the market's going to look like, and why something like this might capture value. The core assumption is that there will be chain-to-chain arbitrage opportunities and liquidations and such that will be kind of critical, and will be kind of contingent upon precise synchronization between those different domains. And this is really what the core offering of the scheduler is. You can basically schedule the availability of block space on different chains in a way that kind of matches those up properly, so that you can capture an ARB, for instance.
Right. Yeah, and a lot of MEV opportunities we see like in other landscapes such as Ethereum. A lot of those are generated from DeFi to DeFi protocols, right? And so that does make sense that like Osmosis would be the one that's kind of like leading the market in MEV creation today. And with things like Mars protocol coming to the ecosystem, a lending protocol built in and around the Osmosis ecosystem, it does make sense that the bets that make sense to place is right. We'd see an increase in MEV opportunities as more of these DeFi applications make their way into the Cosmos. I'd love to kind of change directions a little bit and kind of talk a little bit about liquid staking. It sounded like a lot of the contention, or maybe not a lot, but a good portion of the contention around Atom 2.0 and what's next really came centered around this liquid staking, and doesn't make sense for the Cosmos Hub to create an in-house solution. And so I'd love to hear about why some of that pushback was there, and if the presence of liquid staking in the Tendermint proof of stake blockchains kind of changes the risk assumptions with the chain.
Yeah, I mean, this is another one where it's tough. Like I'd stand behind like pretty much everything that's in the Atom 2.0 paper, but I feel like we were kind of thinking 5 steps ahead, and there's a lot of people who like don't really understand the impact that liquid staking or MEV, or like the combination of these things together, is going to have. So like I spent a lot of my time just like trying to educate people on like the basics of liquid staking and the impact that it's going to have on the validator business. So I do think like a lot of the reaction to the vote was really kind of like there's a lot of things here that I don't like really understand, and like I need more time to kind of equip myself to even make the decision. Liquid staking is definitely one of those. I mean, speaking to validators, like there are very, very few that understand that that liquid staking is going to happen. Just it's already happening. It's kind of imminent, and that it's going to impact their bottom line. Like this is not an Atom 2.0 thing. It's just like there are multiple liquid staking protocols that are at some phase of deployment, and that is going to make staking rewards go down. So that's like just not well socialized at this stage. And so, yeah, I mean, we're kind of like watching validators like go through that thought process like in real time during the vote, and it was kind of interesting. So, I mean, in my view, liquid staking is, you cannot liquid staking. All you can do is kind of internalize it into the protocol and try to, make sure that it's as risk mitigated as possible. And so what you're referring to is like, I believe the addition of the liquidity staking module on the hub. Is that right? Yeah. So there's this module that was developed by Occlusion, and it basically allows a staker today to forego the unbonding process, the 30-day or 21-day rather unstaking process, and directly convert into a delegation share. So it's a fungible token, semi-fungible token that's specific to the validator that you're staked to, and then those tokens can be combined by a third-party provider like Stride or Lido or Quicksilver, and pooled, and one can issue a share of those equivalent to the number of underlying tokens. That is the liquid staked asset. So that would be like ST Atom or whatever. And in my view, and in addition to that, there's a kind of safety mechanism incorporated into the LSM module, which is what we call exemption. So it means that the validator, there's a cap on the amount of staked assets that the validator can, there's a cap on the amount of assets staked to a specific validator that can be issued as a delegation share, and that cap is a function of the amount of self-bonded or exempted tokens that the validator is electing to exempt. And the main purpose of this is just to solve a principal agent problem between so that the validator has skin in the game, so there are kind of like intrinsic interested parties that you can use to kind of backstop the system. So without something like that, in my view, liquid staking is kind of in all ways like more harmful and more dangerous. So it basically allows for immediate interconvertibility, which is important to make sure that the price discrepancy between the underlying and the liquid staked asset is kept in line, and this this principal agent system that makes sure that there is a kind of backstop actor.
Right. So the idea, I guess, is then to kind of, because we see a lot of other solutions coming to market now. We have Stride that's alive. Lido's discussed with Quicksilver as well to come in and provide like those staked assets. And so I guess my question would be, is the idea of putting the LSM directly on the hub then to, like, I guess it changes like how the risk assumptions break down, but given that it forgoes that staking period, would the idea then for like Stride, let's say, to use the LSM themselves, or is this only for individual users or validators themselves?
So I guess an important thing to understand is that if you're a staker today and you want to go into Stride, well, what do you do at this moment? You basically you basically unbond, move the tokens to Stride, and then give them to Stride, and Stride bonds them for you, like restakes them back in. They move them back to the hub and stake them, and then they issue your share. So you need to, you need to unbond in order to get into the system. And people are doing this. Like Stride has incentives on Osmo pools. Like there's a lot of Atom in there. Like that is still happening no matter what. The LSM module basically allows you to do something very similar, except you do it immediately. And this like direct interconvertibility means that there, people aren't going to get wrecked, or less likely to get wrecked because of the, the liquid staked version of the asset running away from the underlying. Yeah. So, but the other thing to kind of understand is that Stride is basically custodying your assets for you in both cases. Whether you're using LSM or not. Stride is acting as kind of a decentralized custodian that's then pooling and issuing these shares. And the end game here is like, if you're going to own liquid staked assets, you're like the primary entities that are going to be directly staking are the liquid staking protocols. So like there's actually going to be way fewer stakers because you're going to become a user of Stride or a user of Lido or a user of Quicksilver, not a user of the Cosmos Hub directly. So you're being kind of intermediated.
Right. Yeah, and that makes a ton of sense. And I like the focus on keeping effort on the staked derivative asset, staying one-to-one with the underlying asset, right? While that's never really a problem in the up-only bull market environment, is the past 6-12 months have shown us, when the market does turn down and liquidity, we start to see a liquidity crunch. People are willing to pay a premium to get that liquidity and have the instant solvency. So love to see the focus there. And just to kind of like recap on what we've talked about so far, right? So interchain security is grants the ability for consumer chains to lease security from producer chains, which really unlocks the scalability of the Cosmos ecosystem, and we plan to see that live sometime in Q1 2023. And then liquid staking, of course, as we just discussed, really unlocks what Atom can be, and it's kind of inevitable, and the hub has an obligation, right, to make sure that the security assumptions of its chain stay in line with the current strong security assumptions today. And then, as we discussed, we have that economic engine with the scheduler and the allocator that helps scale the Cosmos Hub with the growth of the broader ecosystem. But lastly, one thing we haven't really touched on yet is the revamped Atom monetary policy and the idea to kind of like push Atom towards being a reserve currency of the interchain. So there's a lot to unpack even within this one topic. We kind of hit on earlier, one of the bigger contention points was, we need to fund these ideas we have, right? And a lot of that would come through like the community pool. So if you want to talk about how there was some contention around making a one-time mint into the community pool, as well as the creation of the treasury and the tax that goes along with both of those, I'd love to hear you dive in deeper there.
Yeah, sure, I can take this one. So basically, the general idea for the new issuance policy, there were two items. So the first one was to be able to fund the treasury, and then once the treasury is funded, you can work you can bootstrap ICS, interchain security, and then you can also fund the allocator and the scheduler. So that's the first item, the first objective of the new issuance regime. And then the second item was basically to move from almost a hyper inflationary Atom to almost zero inflation Atom if everything was going according to plan. So to the plan. So there was two steps. So the first step was about increasing, like have a one-time pump of the minting to from the treasury, and then progressively reduce the emissions. And that was mainly because of liquid staking. Because with liquid staking, what's going to happen is that the staking ratio is naturally going to trend toward 100%, possibly like 55%, 95%, sorry. And then once you have that, there is basically no more need for inflation, because in the current system, how it works is that we have a target of 2/3 of staking ratio, staked atom. And so when that ratio of 2/3 goes up closer to 100%, then the staking rewards go down, and vice versa. And so with liquid staking, there won't be any more that need. And so the security subsidy, basically we won't need it anymore if we assume that liquid staking is taking that rate closer to 100%. So those were the two main components and reasons behind the change of issuance.
Yeah, in speaking to validators, I think they were rightfully like hesitant about making a monetary policy change that it's going to impact their bottom line. Again, I think that there was a kind of slow motion education process that happened, like after the paper was released and the proposal went up. One of the rationale, and to be clear, like the paper actually excluded some of the monetary policy changes, like after some of these discussions that we had. Not to say that we don't think that it's kind of where we want to go eventually, but it's just like, okay, we'll hold off from this conversation until people, feel more comfortable and we have kind of more direct evidence. But the rationale is basically like, okay, well, today, where does your staking yield come from? Well, it's actually a value transfer from unstaked assets to staked assets. Like that's where money is coming from. So basically, the people who are unstaked are using the assets in the ecosystem, and they're basically saying, okay, I think that I can get a higher yield for this free atom than I can the bonded atom. Liquid staking eliminates this competition between the unstaked yield seeking and the staked asset, because you can do both. You can now seek yield and accrue staking yield. And so the expectation is that the bonding ratio is going to dramatically increase. I mean, theoretically, it should go to 100%. I don't know that it necessarily will get to that stage, but it should increase dramatically. And if you're close to 100%, like even if you have let's say that you have a whatever it is, like 15% inflation rate, well, there's nobody unstaked. The value transfer that was happening previously like doesn't exist anymore. So like what are you actually doing? You're basically just inflating the monetary base. So you're paying yourself. It's kind of like a stock split. Like you're just you have the same amount of value, but you're just redenominating what you have already. So that doesn't make any sense really, and so you should allow yourself to just cap the supply at that point.
Yeah, that makes a lot of sense. I'm curious. This is like a really ambitious roadmap, and I like a lot of what you're doing within it. But is there like at all a timeline that you expect for all this stuff to get implemented? I know it's a pretty fluid situation, but I'm sure a lot of people are wondering what the timeline looks like.
Well, the veto definitely like throws a wrench in some of this. Like there are teams. The informal team is really interested in the scheduler, and I've talked to other teams who like want to build. Now that they've seen it, they actually want to build something similar. Like so, and I've actually had conversations with other teams that want to basically build the allocator. That the ideas are sound, or like at least there's interest in developing them, but I don't think there's kind of like a fully, we don't have like full consent from the Cosmos Hub community at this stage that these can be deployed. So I think it's, the funding is going to happen first. I would hope that some of that can be kind of split off to at least, continue a research process, or kind of early experiment for both of those, the work streams. But it's very challenging to give projections, without that consent, right?
Yeah, and also what might happen is that we end up implementing some aspects of the white paper and not others. So if we decide to take the route of slicing everything, and I think there is some consensus around that, then it's possible that one product like the Allocator gets accepted by the community, and then the scheduler, for example, could be not accepted by the community. And so that's the first element, and then obviously it's all gonna delay the implementation, because at every stage we need governance to step in and decide. So that makes it, that's another variable that we do not have control over.
Interchain security and liquid staking are, kind of on the immediate horizon, and there's like they have a kind of intertwined go-to-market that does need to be capitalized, and so that's kind of why the community spend is the priority at this stage.
Right, and I guess the last piece that really encapsulates what Atom 2.0 is the Cosmos assembly, right, where there's an assembly governance structure that is made up of smaller councils, similar to like a MetaDAO structure that we see in some other DeFi protocols on Ethereum. And so I want to talk a little bit about that, and as well as the charter itself that kind of like outlines exactly what this is. Is there still a plan to push forward on the Cosmos charter and kind of ratify some of these more governance related decisions?
I don't. I'm not sure. I'm not sure about the charter because the charter was, deeply linked to Atom 2.0. But we need, I think, further discussion around the charter. I don't know, Sam, if you wanna add something on the charter itself.
I still think it's a good idea, and it likely should happen. I mean, I've already been in touch with consumer chains that like kind of want some, more social contract about the relationship between the consumer chain and the provider. So I do think that that should continue regardless, but it's going to need to be kind of revisited, and it's not the first priority at this stage. As far as the kind of notion of like the councils and SOs, I still kind of stand behind the like general design. I've worked with Haifa quite a bit to like develop that. The plan now is to expand the community pool. I think it's going to become apparent pretty quickly that the community pool is not equipped to allocate yearly budgets in an effective way, and so there will need to be additional kind of controls put in place, and once you end up doing that, you just get something that looks like the assembly council system, like maybe you're calling it something else, but like you're going to end up arriving at kind of the same conclusion. So just by the nature of like electing to go down this path of like, okay, the hub needs to be allocating capital in some way, either to consumer chains or various kind of strategic initiatives, like now you need to increase the amount of Atom that's able to be capitalized. Well, now you need a kind of control system in order to do that. And so, yeah, like you're gonna get to something very, very similar.
Yeah, I think it's a fair statement to make that no one in crypto has cracked the nut of governance. So I praise you guys for actually trying to implement something new. But we've already taken up about an hour of your guys' time, so I want to let you go. But thank you guys so much for coming on. Hopefully we can do it sometime again in the future.
Thank you very much, guys.
All right. It's quite a bit to unpack there, Dan, but that was a good interview, and I'm excited to get your thoughts. But first, can you give us a quick little rundown of kind of the Atom 2.0 white paper, just to summarize it for the listeners?
Yeah, if we can just repackage basically that whole conversation into a couple sentences, right? So, there was like 4 key areas within the Atom 2.0 proposal. We had interchain security, liquid staking, the economic or growth engine, and the revamped monetary policy. So if you look at each of those individually, right? So we had interchain security slated to go live in Q1 of 2023, so just a couple months away. There's 10 chains lined up to be users or consumers of interchain security. 7 are like independent team projects, and 3 are more central to the Cosmos Hub, right? So we have the scheduler, the allocator, and then also the rumored Circle chain will be a user of interchain security. And so that's really like the scalability feature for the Cosmos ecosystem. One of the hardest barriers to entry of launching a new consumer or a new Cosmos ecosystem chain is building a reliable and consistent and secure validator set. That's just like the hardest building block, but it does create a bunch of optionality. We've seen chains like Thorchain or Osmosis create unique structures based on being able to like remodel their validator sets. So being able to still have the functionality without the lift of like building these more complex groups of individuals and users should increase the number of chains we see. And that's a huge unlock, because that kind of, if we feed into the growth engine piece of this, more chains creates more MEV opportunities, which is like my personal most interesting innovation within Atom 2.0, right? So this scheduler that creates like a marketplace for tokenized block space is super, super interesting. And as somebody who's like not a huge bull for PFP NFTs, this is actually a very, very interesting use case of NFTs, right? So if we think about what blocks, like each block is different than the one preceding it and the one coming after it. So if we have all these different blocks, we need something that represents them they're non-fungible, right? So NFTs or non-fungible tokens are a perfect way to say, hey, you have the rights to ordering block number 2004, and that's different than ordering the transactions in block 2005 and so on. So really excited to like see the evolution of NFT technology be used in this, but more importantly, like this is a great way to be generating revenue for the Cosmos Hub. And also providing like a service to the broader interchain ecosystem. And the allocator kind of falls right along these lines as well, right? So, we see like the allocator coming in and building partnerships with new chains and helping bring them liquidity and kind of like furthering Atom as like this reserve currency of the ecosystem. Of course, an issue with the allocator is they need to have like smaller teams like councils that would sit on and be like the allocator DAOs that like help pick which teams to project with and how that benefits the chain the best. And that's kind of one of these big issues that we still see we're very far away from solving. Even hearing Sam talk about the charter and Youssef being like, yeah, we don't really know if that's like something we're going to continue to pursue for now. That brings me some questions around whether or not the speed at which the allocator will be implemented. So moving on to liquid staking, this one, I think when you break up this proposal and start trying to pass each piece individually, I personally think there's going to be a ton of pushback on liquid staking, and it goes to exactly what Sam said. He mentioned when liquid staking becomes very prominent, that's going to ultimately hurt the bottom line of validators, and so as group of the community members that has a ton of stake in the chain, it's very hard to pass things without their approval. But liquid staking is definitely inevitable. We've already seen the immense popularity on Ethereum. That's sort of like normalized it. I think that's going to come with strength into the Cosmos ecosystem as well. So the creation of like the LSM module that will basically go around the unbonding period to help keep a one-to-one peg with the staked asset and the underlying asset, I think is a great innovation. Biggest concern is I think like just broader education around what that means for the risk assumptions of a Tendermint proof of stake blockchain. I think there's like a huge education period that needs to go on before liquid staking really is going to get validator approval. And then lastly, on the revamped monetary policy, the big takeaway is building these new innovations like the scheduler and the allocator takes funding. And right now, the Atom community pool is quite small. And every new piece of approved funding has to essentially go through full community governance approval, which, as we've seen, is not always like super efficient, right? Like we got a no with veto vote here. Ever since Prop 69, we've kind of seen like the normalcy of using no with veto to vote against or filibust, as Sam mentioned, and it'll be interesting to see how that goes going forward, right? Like, I don't know, they want to break up this proposal into like a couple of different pieces, which I think is the right way to do it. That way you can like pass the things that everybody wants passed and discuss and innovate on the things that don't or that are causing contention. But all in all, I think my biggest takeaway from this is it was pretty disheartening to see it not pass. I was pretty bullish on the idea of it passing personally, because the Atom, like the Cosmos Hub, needs a direction, right? It's just like this early piece of infrastructure that funded so much of the success that we see within the interchain ecosystem. Yet now it's like stalled out. It needs a new vision. It needs direction. And now is the perfect time to be building. So I don't know. What's your take on this? Love to see you try to like poke holes in some of the thought process around 2.0.
Yeah, I can give you some of my low IQ takes. I guess I'm just a little bit concerned about the change in monetary policy, like I see on crypto Twitter. I know there's some good rebuttals to that, but I guess I just am still trying to understand how the high initial inflation and then eventual move to near zero inflation will change validator incentives, like you mentioned. I really don't love how there's not great timelines around this entire proposal. I feel like they really need a concrete roadmap, and I know there's a lot of stuff underneath the hood that needs to go on, both in R&D and implementation. So I would just love some more concrete dates. I know interchain security is kind of a core pillar of the economic engine actually running, and there's really no guarantee it sees adoption. So that's kind of a worrying factor. You think it would be because it makes it so much easier to spin up a chain, but it still remains to be seen. And I think the number one takeaway for me is actually just the struggles in decentralized governance. Like we see this with the Prop 82 not even passing. And, for the allocator to work, we really need like competent governance and efficient governance, not just one token, one vote. Like clearly that model doesn't work incredibly well. I also think creating a futures market for block space demand is a really cool and novel idea, but it's also still just an idea. Implementing that's going to be pretty tough. But if they can, and they've implemented technologies that are used throughout the crypto space today by other projects. So if there's a team that can do it, I think it's the Cosmos core team. But yeah, those are kind of just some of my concerns, and I'm sure there's good rebuttals to everything I just said. But just off the surface, that's definitely my main takeaways.
I agree. I mean, the timeline thing is probably the biggest concern here, right? Like we're in the depths of a bear market, and now's the time that you'd want to see a project have a solid plan and just be like building in a direction. It feels like the Cosmos Hub is this great group of community and intelligence, but like the aim of the community is still so broad. If we could really like narrow that in, which again was what this proposal tried to do, I feel like it just needs to like get a kickstart in the right direction and start grinding away. And then on the inflationary piece, the reason why it was so inflationary up front is because a lot of that funding went to the treasury and the community pool. So that's why it looked like this massive inflation. But in reality, like how those tokens would be distributed, I don't think it would have like this huge negative effect that you would if you just like minted tokens and, let's say you just distributed them to stakers for like a one-time reward or whatever. And just as an example, that would be a ton of sell pressure, right? But if I'm using these tokens to fund the creation of new chains and like these tokens get like used as salaries for developers, I think that'd be like a much slower bleed in terms of like true inflation effects. Plus, you're also like funding the creation of new pieces in your ecosystem. So like I feel like it's a net benefit, but it is definitely like when you look at that chart up front, it's like, okay, it's a little alarming seeing this massive spike in inflation. But if that's like enables us to beef up interchain security and allow the revenue from that to offset the ultimately decreasing inflation, then I feel like it's like a situation where you have to pay a little upfront to get to a steadier state in the long run.
Yeah, strong agree there. I definitely think, if there's a team that can do it, it's the Cosmos team. They're one of the few teams working on kind of like an ecosystem architecture that's actually like really interesting to me. But yeah, time will tell. But I think that's a good place to wrap it, unless you got anything else, Dan.
I think just like closing notes for me would be, I thought it was really interesting that the charter kind of just got not thrown to the wind, but definitely put on the back burner, right? So because of the no with veto vote, it's like, okay, well, let's take this one at a time, and like, in what order do we act now? And it just feels like the revamped governance will get put on the back burner, which is a little disheartening, right? Like, you mentioned it earlier, that one token, one vote model is definitely not perfect. And even in the interview, we discussed it's like the golden bullet hasn't been found yet, right? So would love to see more innovation on this, and would have been nice to see like the charter kind of getting pushed in a direction and like just more discussion around what protocol governance should look like. But time will tell.
Couldn't agree more. All right, everyone, we'll see you next week on the next episode of 0x Research. Thanks for tuning in.